Mira, how do you view the geopolitical risks out there and what the appropriate market response is?
Certainly, geopolitical consequences could be pretty severe in this case. But from a market perspective, ultimately it comes down to the fact that markets do not like uncertainty. And we're seeing a lot of uncertainty right now amidst an already pretty fragile tape. I think the biggest transmission mechanism here in terms of this potential conflict is through oil prices and energy prices and how that might put some pressure on global growth and the consumer. I think the impacts could be perhaps more severe in areas like Europe that are very reliant on Russia for energy and maybe a little bit more limited on the US. But overall, we're certainly seeing a sentiment impact and people looking to hedge in areas like gold, treasuries, the dollar. But what I would say is that investors shouldn't scurry to reposition their portfolios because ultimately what we have seen in the past is that from wars and geopolitical events, markets tend to have a shorter lived reaction to these types of issues.
Mira, can I just come back to the sort of the gold dollars kind of story? Are they enough of a hedge? A lot of people are starting to talk about just simply getting into cash, and that is the best place to be right now. As you say, lots of uncertainty, hard to quantify, potentially creating opportunities, but we operate in a difficult environment. Are we in a position where we should be upping our cash components in terms of portfolios?
Well, from a gold and treasuries perspective, I think we hedge on the margin. But essentially, in terms of moving to cash, it's just such a challenging trade to make right now when you think about the context of how high inflation is and how you're losing your purchasing power there. I do still think that there are many areas of the market that should be well supported, given the backdrop of strong global growth overall and above trend growth that has a bit of a cushion here, a strong consumer, strong earnings. So I don't think that we want to broadly reposition too much or we should be too worried about hedging too much. Look, the uncertainty is not great, but at the same time, we do want to keep an eye on the fundamentals that are going to be supportive of markets in the longer run.
Mira, you talked there about a strong consumer, strong growth, underlying kind of macro fundamentals. Are you not worried that if the Fed tightens aggressively, if it front loads rate hikes like Bullard would like to see them do, that it actually is going to choke off growth down the line and start to be a problem for some of the cyclical areas of this market?
It's absolutely a concern and one we're paying attention to quite closely. And that's why we would be more biased to closer to 4 rate hikes this year, as opposed to some of the other expectations. Now, we could see a bit of a front loading given the fact that we're still seeing pretty strong economic indicators across the board. But we do expect that a lot of that is going to moderate by the second half of the year. So if the Fed continues on a very aggressive path, that could really jeopardize the growth situation we're in. I think the good news is that we're not necessarily in a growth scare here. We are above trend when it comes to growth and really strong when it comes to consumption. So there is a bit of a glide path here from that standpoint.
Mira, if energy prices stay as high as they are, and the consumer, particularly the US consumer, is super sensitive to gas prices, if they stay as elevated as they are right now, do we need to call into question that strong consumer thesis?
Ultimately, with the amount of cash on the sidelines in terms of how much consumers have and this backdrop that they do have, look, we naturally do see some degree of moderation in the consumer throughout the year regardless. But as we see economic activity open up, things open up more, it should still be a good environment for consumption. I think where we're going to see the biggest impact when we think about higher oil prices and higher energy prices is among the lower income households for whom those utilities and filling up the gas is a higher proportion of their overall budget. But from the perspective of the consumer in aggregate, I think that there's still a good amount of cushion there for this consumer to withstand higher inflation. And yet what we're seeing from all of the surveys is that willingness and that appetite is being dampened a bit by inflation. Energy prices, of course, are likely to continue to put some upward pressure there. So the hope is that even if consumer sentiment is somewhat dampened, it doesn't necessarily dampen their ability to go out and consume to some extent.
And of course, this isn't just a U.S. story, Mira. There's a real cost of living squeeze in the U.K., for example. And I'm wondering how you're viewing where regionally you want to put your money right now.
We'd still actually advocate for a relative balance. I mean, last year when we took a look at the broad international landscape, essentially it was really hard to resist being invested in U.S. stocks. And yet what we're seeing year to date so far is that areas like China, many of the Asian economies, Europe, Japan are actually holding up quite well from a stock market perspective in comparison to the US. So we're seeing a bit of outperformance there. And if last year was the year in which the US saw a very strong recovery and this year is normalizing, this year we could see more durable international recoveries. And what we tend to find in these international markets is that degree and that cyclical exposure there is much higher than you see in the US. So many of these areas are essentially levered to the recovery there. So we think that some of the earnings estimates out there internationally are a bit too conservative. Now, look, this geopolitical risk, of course, creates a headwind. Higher energy prices do create a headwind. But overall, the direction of travel, we think, is global recovery in terms of growth.